All right, folks, we're going to now do a recording for the masterclass for test 2 to replace the aborted attempt that we had this afternoon to run our live session. Once again, my sincerest apologies for that, but let's get on the road and get you helped anyway. And you will be using this when perhaps it's more convenient for you. So good luck for the test. All right. Remembering what your test covers, which you all should know by now, but that will be Learning Unit 4, which is Chapter 16, Learning Unit 5, which is Chapter 13, and then Learning Unit 6, which is Chapter 17. That is the foreign exchange market, measuring economic performance or measuring the performance of an economy, and then the Keynesian model. This one is now irrelevant. Folks, remember that what you are doing is both theory and application, but theory requires you to memorize. What we are finding is that a lot of students are pretty darn good at the application. So when we give you application questions, you're good at them, you can answer them, but you're battling with your theory questions. And that unfortunately means you've got to memorize better. So please do make sure, especially for this test, we know there was a fair amount of theory in test 1. There's likely to be a fair amount of theory in test 2 as well. Here we go. Learning Unit 4, Chapter 16, the foreign sector. Let's take a look. 2 types of questions you can expect, the one being pure theory, which is question number 1, and the second one being an application question. Remember that Learning Unit 4 is made up basically of 5 parts. You have your basis for trade, which is your comparative and absolute advantage. You have your trade policy, which you have to investigate. You have exchange rates, which we must know in detail. We have exchange rate control, and then we have terms of trade. So basically 5 main sections that are covered. Make sure you know all 5 of them. It's not a lot. Simple, straightforward information, but you need to be aware of which section you're covering at any point in time. All right, so these are both from the very first section, which we're going to have a look at now and see, first of all, how would you answer that 6-mark theoretical question, and then how would you answer this somewhat more application-based question. There's your theoretical question. Differentiate between absolute advantage and comparative advantage. Remember, absolute advantage looks at how a country is able to produce more with a given set of resources, whereas comparative looks at simply calculating the opportunity cost. In the case of absolute advantage, no calculations required. In the case of comparative advantage, yeah, you do need to calculate. We're going to do that now. Here's an example for you, Malawi and South Africa. Let's look first at who has an absolute advantage. You should be able to tell me quite easily that South Africa has an absolute advantage in the production of cloth, and South Africa also has an absolute advantage in the production of maize. And then what you do is you go in and calculate your opportunity costs in order to work out comparative advantage. All right, let's go and see what you should be doing there. Actually, before I do that, let's do it before we have the answers in front of you. Let's remind you. What we want to do is this is all. So when we are looking at these 2 countries here, we are looking at them using their resources to produce either cloth or maize. That means that if you want to produce cloth, you have to give up producing maize, or if you want to produce maize, you have to give up producing cloth. And that is where the origin of calculating the opportunity cost comes from. All right. So in South Africa, if we wanted to produce 100 meters of cloth, we would have to sacrifice 50 kgs of maize, or vice versa. If we wanted to produce 50 kgs of maize, we would sacrifice 100 meters of cloth. Now, in order to be able to work out opportunity cost, we want to reduce this to 1 unit. And in order to do that, we simply used a simple arithmetical or mathematical technique. So we say 1 unit of cloth is equal to, and then whatever is the number for cloth goes at the bottom. In this case, it's 40. And then the number for whatever the other product is goes at the top. So that tells me that is equal to 10 over 40, which is the same as being equal to 1 over 4, which is 1/4 of a kilogram of maize. So in order to produce 1 meter of cloth, I'm going to have to sacrifice 1/4 of a kilogram of maize. That's your basis that you're using to calculate your opportunity cost. Now let's go and have a look at the completed costs and see if we can interpret them. There we go. We've completed the calculations. Don't worry if at this point you're not quite sure what you're doing or you're not thinking of what you're doing. You're just doing the sums. Once you've got the sums, then the thought process starts. Because now what we have to do is go and see which country could export maize. And in order to do that, we've got to interpret all of this information. So we compare first 1 unit of cloth in Malawi. We can see we're going to sacrifice 0.25 unit of maize. In South Africa, 1 unit of cloth, we're going to sacrifice 1/2 a unit of maize. That should tell you, if you're interpreting it correctly, that cloth is cheaper to produce in Malawi. But the question isn't asking us about cloth, it's asking us about maize. So let's check out maize. Maize in Malawi, we're going to have to sacrifice 4 units of cloth. But maize in South Africa, we only have to sacrifice 2 units of cloth. That tells us that maize in South Africa is cheaper. Let us specialize in South Africa in the production of maize, and then we can export it to other countries. So the answer to your question would be South Africa should specialize in the production of maize and would export maize to other countries. Be sure you can do that, all right? And then I give you an explanation. In case you didn't follow what we were doing there, your explanation is there, and you can read it through and make sure you can understand why it is South Africa that should be exporting maize. Next section in Learning Unit 4, Trade Policy. Kinds of questions you could be asked for trade policy. Once again, these are all theoretical. These are not application-based questions. Notice the one for 6 marks where you're going to describe different methods of limiting imports or different barriers to trade, as they would be called. And then can you define an import tariff? And then can you also distinguish between an ad valorem tariff and a specific tariff? We give you the most information on tariffs, and so you can expect the most questions to be on tariffs. But we can also question each of the others. Be sure that you can describe, at least in brief, each of these different restrictions that we can place on imports. All right, that's what we're looking at. Look at all the names: forms, measures, methods of protection, barriers to trade. So many different ways we can give this information or ask this of you in a question. Be sure you recognize it. And now we get to the section that is most likely to be asked in the test. Usually as a longer question, and that is asking you to explain and draw what will the impact on the exchange rate with another currency, the South African rand with another currency, depending upon the scenario that they give you. All right, but before we can do that, we've first got to define an exchange rate and then differentiate between exchange rate system, and then a foreign exchange market. Here you go. There's an example of some of the questions that we could be asked. We'll come back to those. But for now, just take note of those and then make sure at the end you are able to answer them. All right, so there's your definition for your exchange rate. Can you define it? Can you do a conversion if necessary in a simple 2-mark multiple choice question? Are you able to do a conversion? Would you be able to describe the foreign exchange market? You might know in your mind, yeah, I know what a foreign exchange market is, but can you tell us? And then do you understand that exchange rate system is the system within which the framework within which we operate? So an exchange rate system, when I'm teaching you now about demand and supply, is a floating system. Whereas if we were teaching you about a fixed system, we would have to look at a specific fixed value of the rand in relation to some other value, e.g. gold or dollars. All right. So the system that we are using when we talk about appreciation and depreciation is that one. It's the floating system. Let's go look a little bit more at that floating system and see whether you're able to answer questions on it. There we go. Learn the rules, folks. When you are looking at the determinants of demand and supply, make sure you know all those determinants that will impact on demand. So all of those that will cause an increase in demand for dollars in South Africa, because whenever you're looking at the foreign exchange market, you want to put yourself on the South African foreign exchange market, and you want to ask the question, do we need dollars to pay? In other words, are dollars or pounds or euros going to flow out of the country, or are we receiving them from foreigners who are paying dollars or bringing dollars or euros or pounds into South Africa? If we're looking at demand increasing, all of those would be or imply that these are going to flow out. Dollars are flowing out of South Africa. If we're going to have a look at supply of dollars increasing, that implies that all of these transactions are going to bring dollars into South Africa. So your first question you have to ask when you see the scenario that they give you is, are we looking at demand for dollars or are we looking at supply of dollars? That brings us to another rule which you would be able to apply, which is this. Anything that increases the demand for dollars or any foreign currency in South Africa will lead to a depreciation of the rand. Anything that increases the supply of foreign currency coming into South Africa will lead to an appreciation of the rand against that currency. All right. So these two rules should help you, keep you on track when answering questions. Now with the graphs. All right, let's give you a little scenario. First, let's look at the equilibrium in the foreign exchange market. Please, students, when you're drawing your graphs, remember, what does your labeling look like? There is your vertical axis, the rand price of the dollar. Rand must come first, foreign currency second. And here you have quantity of whatever that currency is. If you just put quantity, you won't get all your marks. Then you have your downward sloping demand curve, your upward sloping supply curve, correctly labeled, and where they intersect is obviously your equilibrium position. And then don't forget to mark your equilibrium price of the dollar on the South African foreign exchange market, and then mark your quantity. Notice we use a number for the exchange rate, the price of the dollar, and we just use Q for quantities. Now let's give you two scenarios. There we go. Both these scenarios lead to the same result. But don't first think appreciation or depreciation. Just think, is it demand or is it supply? Once you've got that correct, then you can go to your next step, which will be what has happened to the value of the rand as a result of that transaction. So South Africans buy more from USA or South Africans travel to the USA, you should quickly be able to tell me that that is a demand, or rather an increase in the demand for dollars in South Africa. So there we see our D1, and we see our equilibrium position. Has changed, and then we read our graph. What has happened to our equilibrium position? Remember to show me this. Our value, or the price rather, of the dollar in rand terms has increased. So we are now paying more for our dollar. So let's go 17 rand for our dollar. That means that the rand has depreciated against the dollar, and the dollar has appreciated against the rand. Let's go and have a look at the completed correct solution for you. Always like just to show you what it looks like first, and then go and have a look at what it properly should look like. There you go. So there you'll see the demand for the dollar in South Africa increased. That has shifted the demand curve to the right. New equilibrium position showing that the price of the dollar in South Africa has increased, and the quantity has also increased. The equilibrium quantity has also increased. This shows that the rand has depreciated against the dollar. Practice these before the test. All right, let's try another one. Here we go. Giving you a little bit of a scenario. There we go. Giving you a moment or two to think about it. If you didn't know the answer straight away, you need to go and do some more work on this, all right? In this case, supply shifts to the right. Supply of dollars coming into South Africa has increased. There are more dollars in South Africa. As a result, the price of the dollar in South Africa has decreased. And we have a new equilibrium position. And the rand has appreciated against the dollar. All right, looking at the correct answer. Let's go see. Sorry, we've just got to get rid of that quickly. There we go. There's your correct answer. So those are the two obvious ones that they can ask you. Scenarios which you should be very familiar and comfortable with. If you can do these, then you should be able to deal with anything else. So now we're going to go and look at two more tricky ones and see if you would be able to deal with those. Here comes the first one. What if imports from the United States decreased? Now we know that if imports increase, so if imports increase, we know it's demand. If they decrease, it is still demand, but your demand curve is just going to shift in the opposite direction, all right? Or fewer South Africans travel to the United States. Here, we would simply look at shifting the demand curve to the left, showing a decrease in the demand for dollars. And therefore, let's put our D1 here. We still must complete our graph. Now, this time I haven't got solutions for you. So I'm going to just do it quickly here for you, just to show you. And what we must do is make sure we show all the required information. So here's my new equilibrium position. We can see that the price of the dollar in South Africa has decreased. We don't know where it's gone to, but we can put in anything that's less than 16.80. So let's just put in 16 Rand, because 16 Rand would be less. And then we put in quantity Q1, showing that the equilibrium quantity has decreased. And then that's what you tell me in your explanation. The demand for the dollar in South Africa has decreased. The demand curve has shifted to the left. The equilibrium price of the dollar in South Africa has decreased, and that indicates that the rand has appreciated against the dollar. The dollar has depreciated against the rand. And then two different scenarios. Let's have a look at these two. What if interest rates in South Africa increase relative to the United States interest rates? Now you've got to think carefully about this one. What we're saying here is that if you have a lot of liquid financial capital, in other words, you have money sitting around in accounts doing nothing for you, you want to put it where the interest rate is the highest. And that means if you were an investor sitting in France, you would say, we need to put our money into South Africa. Or let's take you from America, because we want to talk about dollars. You want to put your money into South Africa. What would happen is we would see an increase in the supply of dollars coming into South Africa. So there comes our supply curve shifting to the right. And that is showing that once again, our equilibrium price of the dollar has changed. There we are there, sitting at equilibrium. Let's call that E1. And there we have a decrease in the price of the dollar in rands, telling us that the rand has appreciated against the dollar. In this case, we have an increase in the equilibrium quantity. So you would go there and put there Q1. For your value of your rand, try and put anything that is lower than 16 Rand 80. So let's go to 15 Rand. Let's say we really saw a big appreciation of the rand here. You can make it any number you want, as long as it's less than 16.80. And there we have our situation. If interest rates in South Africa increase relative to the United States of America, right? But now the second one, B, is not the same. Let's go and have a look at what B tells us. Here we're now looking at a decrease in the price of crude oil. Dollar price of crude oil decreases. Well, what do we know about us in South Africa? We have to buy crude oil. So we are having to buy dollars in order to buy oil. But now, because the price has gone down, the price of crude oil is decreased, we need less dollars. Therefore, the demand for dollars will decrease. Demand will shift to the left, and as a result, the rand will appreciate. So your outcome on your rand is the same, but it's coming at it through different areas in your foreign exchange market. That's what you're going to have to watch out for, right? That's the tricky part of these questions. And the more you can practice, the better you're going to get. So whatever you've got available to practice with, just make sure you do go and have a look and see, test yourself, see, no matter what they give you, are you able to come to the correct conclusion? Let's hope, fingers crossed, ladies and gents. And then once you've worked out appreciation or depreciation, what you've got to do then is be able to carry that throughout the economy. And this relates to this little table, which I'm sure you did in class. Be sure that you still can do it. And are you able to tell us, in each case, when the rand depreciates, what will happen to export prices, and then what will happen to the volume of exports? What happens to import prices? What will happen to the volume of imports? And then as a result of that, what is the impact on the current account? Remember, X is your exports, your volume of exports. Z is your volume of imports. Very important, ladies and gents. You can't learn this table off by heart. This you've got to understand. So this is a combination of theory and application. And they can ask you bits of it. So they could ask you just what happens to domestic prices, or they could ask you what happens to import prices, or they could ask you what happens on the current account when the rand depreciates. Obviously, to know that, you've got to know all of that. Practice it, go through it, see, can I do it without looking? Do I remember what happens in each case? And do I know why? Because if you know why, then you're going to remember it quite easily. Your exchange rate policy, remember, exchange rate policy is what to do if the rand is very volatile. In other words, if we find tomorrow it's up strong, next day it's down low, it's depreciated, what can we do in order to try and intervene and prevent this volatility? Well, we've got three options: do nothing, intervene in the foreign exchange market, and use interest rates to influence the exchange rate. But do nothing is pretty straightforward. Make sure you can describe. It says do nothing, i.e. we will allow demand and supply to determine the equilibrium level of the exchange rate. All right, so that one's fairly straightforward. The problem with the other two comes in if they're asking you specific questions. So did they ask you or tell you that the rand is depreciating or appreciating? And then how do you use intervention in the foreign exchange market? And how do you use interest rates? All right, so just be sure that you go in and check on that information. Would you be able to explain in a little bit more detail these two options that the South African Reserve Bank has? We would usually say the monetary authorities, and usually we are referring to SARB, all right, South African Reserve Bank. Terms of trade, pretty much what you see here is what they could ask you. So they could simply ask you, how do we measure it? The terms of trade, and then you tell us export price index divided by import price index. Often they'll just say export prices divided by import prices. That's also okay. Times by 100. And then just know that if the number gets bigger, that means we can afford to import more because our export prices are increasing relative to our import prices. If it gets, and we are basically as a country becoming richer, if that number gets smaller, we are seeing our import prices are increasing way more than our export prices, and that tends to indicate that the country is getting poorer. All right. So it's your ultimate relationship between the numbers, i.e., are they getting higher or are they getting lower? That is going to give us the answer to the question they could potentially ask you here. And that is the end of Learning Unit 4. Now, if you think back to some of the questions that we've looked at, we have covered everything that you would need to answer any of those questions. However, bear in mind, that does not mean that the examiner can't come up with different questions. But pretty much, I think, I'm thinking back over everything that we've covered most of what is critical in this learning unit. So you should have enough information to answer most of the questions that they could ask you. All right, we're going to take a short break, or I'm going to take a short break now. You can stop your recording if you like, or just let it play on. I'm going to be gone for about 2 or 3 minutes, and then I'll be back to deal with Learning Unit 5. Alrighty, we're back. Let's have a look at chapter 13, learning unit 5. And we're going to learn all about how to measure the performance of the economy. Once again, this chapter is a challenge, and that is because there's just so much content, and it's very, what I call very bitty. So you've got to know bits and pieces about everything. There's no one theme that you're following all the way through. My advice to you is start off with, which is what we'll start with, the macroeconomic objectives, and then just make sure that you know enough about each of those macroeconomic objectives. And then that should keep you pretty much on track in terms of most of the kind of questions they would ask you. Let's have a look at what sort of questions you can expect. Here we go. So full employment is one of the macroeconomic objectives of policymakers. Briefly describe 4 other macroeconomic objectives. We're going to have a look at those in a moment. Just be sure you can describe them, not just name them. And then clearly distinguish between GDP at market prices and GDP at factor cost. That's your different prices. You remember you've got factor cost, basic prices, and market prices, and then gross national product as opposed to gross domestic product. We'll have a look at all of those and be sure that you will be able to deal with questions on them. Here are some more questions. A 6-mark question. Briefly describe 3 ways in which a country's economic activity can be measured. And that would be your 3 methods of measuring GDP, your income method, your production method, and your spending method or expenditure method. And then 3 ways in which double counting can be avoided when calculating gross domestic product. We're going to have a look at that in a little bit more detail. You can see, folks, just from even the very first part, which is really just economic growth, there's a lot of questions that they can ask you. And of course, that is the case with each of the macroeconomic objectives. All right, so starting with your macro objectives, here they are. Make sure you can name them, you can describe them, and then you can also tell us how we should measure them. And then you're pretty much halfway there. The one that takes most of the time is this one here, because GDP is quite a complex concept. So we tend to spend a lot more time on economic growth, and then we kind of race through the others, but they're all just as important. All right. So looking at gross domestic product, which is one of the tools of measuring economic growth in our economy, you must be able to define GDP. It's one of the definitions that is often asked in one or other way. Make sure you've got it word perfect. All right, there's no half measures with a definition for a gross domestic product. It has to be pretty much spot on. Then how to avoid double counting when calculating GDP. We do that by using different methods to measure economic activity. And it relates very closely to our methods, our income method, our production method, and our expenditure method, but we call it a bit differently. Let me show you what I mean. Value added method, which is really production method, and we refer to gross value added. Final goods and services, so we measure only the final goods and services that are produced in the economy. And then we can use the expenditure method, which is C plus I plus G. All right, so those are your 3 ways in which we avoid double counting. Don't mix them up with the 3 methods of measuring GDP. You talk about them differently in each case. Let's look at value added in a little bit more detail. What does value added mean? And GVA, remember, is gross value added, and that is referring to GDP essentially, but at the factor cost or the production level of measuring. Your value added is simply not or distinguishing from your value of sales, which you'll see here in this little column here. There's your value of sales. So in other words, as we sell everything in the economy, if we had to count all of that, we would end up with that number there. This is, let's say, this is a little snapshot of bread production in the economy. So the farmer plants the wheat, the miller makes the farmer then sells the wheat to the miller who makes the flour. He sells the flour to the baker who makes the bread. The baker sells the flour to Checkers or Pick and Pay, and they sell it to us. All right, so that's how that works. But now, how do we stop this which is overestimating big time. This is double counting big time. We've got to prevent that from happening, and we can do that by using what we call the value added method. And that says what we'll do is we will add just the value added at each stage. So we go into the first one, the farmer. Well, before the farmer planted the wheat, there was no wheat. So his value added is the full on 25,000 added by the farmer. So he sells that to the miller. The miller pays 25,000 to the farmer, and the miller gets the wheat. The miller now turns that wheat into flour. The question is, how much value did he or she actually add? And that is simply the difference between those two numbers. So that's what we can see there, 3,500. Then we do the same for when the miller or when the baker now adds value. How much value does the baker add? We can see there that is simply the difference between those two numbers. So there's your value added by your baker. Your baker sells the bread onto the retailer for 38,900. But what was the value that the retailer actually made? Oh, that's me making a mistake. Your baker is going to sell it onto your retailer for 34,700. And then we ask the question, how much value does the retailer, Checkers or Pick and Pay, how much value do they add? And there we see they add 4,200. We add all of that together, and that will give us the final value, which is the retail value of those final goods and services. All right. So that is the value added method. Look, they can give you a little table like this and then ask you to calculate, but then they can mess with it as well, and they can say what happens or what will the value added be if we imported the wheat. So then we would have to go and have a look and say, all right, if we imported, that means that this was not produced in South Africa. So this cannot be added to our GDP. This was imported. Therefore, our GDP would be just that amount. So we would go and subtract from that 38,900, we would subtract the 25,000. And that would then give us the actual value of the goods produced in South Africa. All right, so I don't anticipate they're going to confuse it like that for you, but it is possible that they could ask that question. It's a perfectly legitimate question. Just know that by using the value added method, we can avoid double counting, and then also note that double counting overstates the value of GDP or overestimates the value of GDP. Moving on. Can you fill in the missing words? Here we are looking at methods and prices. So you should be able to identify each method with its relevant price. I'm going to give you a moment to think about that. All right, your income method uses factor cost. Your production method uses basic prices, and your expenditure method uses market prices. Please, ladies and gents, be able to link your methods and your prices, and then know what you're talking about when you talk about factor cost or basic prices or market prices. And then, of course, for the application, you must be able to work or calculate or convert from one to the other. Now, in the textbook, it goes from market prices back to factor cost. That can be a bit confusing for students. So just be aware of the fact that it depends on what they're asking. So if they're asking you to go from the customer back to the factory, you're going to have to do a certain calculation. If they're asking you to go from the factory to the customer, you're going to differ your calculation slightly. Let me show you what I mean. Here we go. And I say there, watch out for the direction of the change. Here we are going from the customer. So let's put a little note here. So from the customer or the market. Sorry about this, it's so slow. I wish we had a text thing. And if there is one, somebody should tell me so I know. We go from the customer, and now we go to the factory, back to the factory. So what do we have to do? We have to take off any taxes that we've added on, because you and me, we have to pay a VAT, so we know at least that's been added on. Plus, there's a whole lot of taxes that firms have to pay, which are part of their what we call production taxes. And there we go back to the factory. So that also helps me to remember factor cost, factory. All right. And that does not include any subsidies or any taxes. So when we get to this one here, all taxes, all subsidies have been removed. So let's go back to the beginning of the formula again. GDP at market prices, that's the customer. Now we want to go back and find out what did it cost us in the factory. So what we're going to do is we're going to take off the taxes that we added on. We're going to add back the subsidies on products and the taxes on products, and then we'll get basic prices. That brings us to midway, basic prices, and then we will take off the taxes that are on production, and we will add back the subsidies on production, and we will be back at the cost of factors of production. All right, so what I call this is backwards, because for me, this was very confusing for students learning it for the first time. Let me go and show you what I mean when I say it's forwards. Either which way, it doesn't matter. You come to the same results, but let me show you what we mean by when we look at it going from the factory to the customer. Here we go. There. Now, notice here, once again, I referred to direction of change. Now we're going from the factory all the way to the customer. This kind of makes more sense often, and students find this often easier to learn and memorize, and then they can work it out if we have to go backwards. So now we're going to go from the factory, factor cost, no taxes, no subsidies. Then what do? We add on taxes on production. That'll be things like payroll taxes, things that you maybe don't know about yet because you're not in a factory situation or you're not in a production situation. So things like payroll taxes, less subsidies on production, and that might be like they introduced at one point a youth subsidy for employing young folk. So then that would be where that gets deducted. And that would give us gross domestic product or GVA at basic prices. And then what we want to do is get from there to market prices. And in order to do that, what are we going to do? We're going to add on VAT, because we know we've all got to pay VAT. And we're going to take off any subsidies that would maybe be helping to make products cheaper. Now, many of us wouldn't have had that experience because perhaps we don't buy products that are subsidized, but there are products that are subsidized. So there you have it, folks. If you've learned this, and I would say maybe this way is easier than the other one because it makes more sense. And then if they ask you to go back from the market, from the customer back to the factory, then hopefully you'd be able to work out. All we have to do is change the plus to a minus. So where we say plus, that becomes minus. Where we say less, that becomes plus. So hopefully you can work all of that out. We'll have a practice just now. Then don't confuse those prices with current and constant prices. All right, make sure you see the difference between these two sets of prices. When we're looking at current and constant, we're looking at the difference between nominal and real GDP. Current, nominal, today's prices. So when Stats SA measures our gross domestic product, they do it at both. They do it at current prices, and then they do the conversion to real prices or constant prices as well, so that we can tell. Because we ask the question here, how can we tell if production has really increased? We can't do that when we are looking at nominal GDP, because it could be an increase in prices, or it could be an increase in the level of output. But once we're looking at real GDP, then we know we've taken out the price increases. And so we know that what we're seeing is a change in the actual production in the economy. All right. So NB, watch out for everything that I tell you on these slides tells you something important. All right. There's nothing in these slides that isn't significant. Make sure you understand all of it. How do we convert from current to constant? We use the prices from a base year. So that's what we mean by constant prices. We are using the prices from a base year, and we are keeping the prices the same. So let's say our base year, where are we now? 2025. So let's say our base year was 2020. What we will be doing is calculating the value of all production using 2020 prices. And then we'd be able to see, has it increased or hasn't it increased from the year 2020? And then that's real GDP, and that we can use to calculate the economic growth rate. Now, remember, you learned in Learning Unit 1 in first semester for Microeconomics, you learned how to calculate a rate of change. And that's what we're looking at here. When you look at the economic growth rate, it is a rate of change. New minus old, divide by old. But now we'd like you to be able to say real GDP for, say, 2020 minus real GDP for 2019, divide by real GDP for 2019. We'd like you to now be able to put in the correct numbers. The correct terminology, rather. All right, so let's have a bash at this. I'm going to give you a moment or two to look at it, to read through everything that it says on the slide, and then we will go in and I'll explain briefly how you should approach the calculation. And then obviously there is a solution slide for you, and you can see, have I done it correctly or not? All right, giving you a moment or two to look at it. All right, so before you can answer this question here, you have to first complete the first part. All right, so you have to do this, you're calculating of nominal GDP. Now, in this case, it hasn't asked you to calculate real, it's only asked you to calculate nominal. And that means we can simply do P times Q for each of the years. So what you're going to do is you're going to do a P times Q, so there's your Q times price, there, and what you're going to do for each of the products, you're going to get the total. And once you've got all of those totals, so let's look at that first one, 1,000 times 1 rand, that'll be 1,000. 2,000 times 3, that's going to be 6,000. And 600 times 5, that's going to be 3,000. That's 3,000. So once you've got that, then you just add them up. So once you've got your totals, you go equals for each of them, and you add them up. All right, I'm going to show you on the next slide, and then you'll have your nominal GDP for 2014. And then you go do the same for 2015. So 1,200 times 1 rand 50, 1,800 times 4 rand, and 500 times 6 rand. And then you go and you work it out, and you will have nominal GDP for 2015. Let's go and show you what that would look like. There you go. 2014, Q times P or P times Q, it doesn't matter which way you put it. And there we have all of our information, 10,000. And there we have 2015, and our total value of production at current prices was 12,000 Rand. All right, so now the next question said, would you say that the percentage increase in nominal GDP in this economy from 2014 to 2015 is due more to increases in prices or increases in the amount of output? Now, you could go in and you could calculate your new minus old, divide by old, times by 100, and you could give me the actual percentage, but they haven't necessarily asked us to do that. I would have actually, on reflection, I haven't put it into my answer, but I would do that calculation anyway. But then I would go in to give the explanation. Based on the information provided, the increase in GDP is because of the increase in prices. Why do or can we say that? Let's go and have a look here at the information. If we look at tomatoes, yes, production did increase. But look at tofu and look at tacos. Both of those have decreased. We are producing less in 2015 than we did in 2014. Therefore, we cannot really say that we've had an increase in production. the increase in GDP from 10,000 to 12,000 is probably more likely because of those increases in prices. Because we can see in every case, prices have gone up. So in not one single of those products has prices stayed the same or gone down. Therefore, we can draw the conclusion that the increase is mainly due to an increase in price. Or we could get specific and say, in the case of tomatoes, the quantity increased, but in the case of both the other products, the quantity has decreased, the quantity of output has decreased, but prices have increased across the board. All right, so something along those lines. You don't have to give exactly what I've given here in your answer, but you've got to explain it to us. And then, of course, based on the information, the GDP is because of an increase in prices. This can be proved by calculating real GDP for 2015. And if we calculate real GDP, we discover that it's 9,100, which is definitely less than 10,000. So there's a couple of different ways of answering this question to get the marks. It doesn't have to be exactly what I've done. This is just one of the ways that we could get those marks. All right. So ladies and gents, this would qualify as a fairly challenging question. But just be sure that you can do the best you can. And if you practice it, you should be able to understand what's going on there. All right, this is something that is most likely going to come up, maybe not even in an application, in other words, not with a calculation, but just with a explain how you get from gross domestic product to net domestic product, for example, or how do you get from net domestic product to net national product. Please know your differences because this is going to help you both with a theoretical question and an application question. What am I talking about? Here we go. There we go. So if we want to go from gross to net, what do we have to do? Subtract consumption of fixed capital or depreciation. And that will give a net domestic product. Then if we want to get to national, what is changing? Domestic is now changing to national. We do another calculation, and that would be primary income receipts and primary income payments. And now we get to net national product. Now, we don't have to ask you all of these. We could ask you just one. We could just say, what is the difference between GDP and NDP? And then you've got to explain to us that it is the consumption of fixed capital. Or we ask you, what is the difference between GDP and GNP? And then you must just explain that it is just domestic versus national, and then tell us what you would do to get that difference or make that conversion. All right. So do the best you can once again, but focus on understanding what is the difference between each of these. Because I think if you do that, then the calculation becomes obvious to you. You'll be able to work out what is required. This one is also a commonly asked one for many test twos. It's been there. And that is the difference between gross domestic product or gross domestic expenditure. I find it easiest to remember it through these little identities. That is what helps me best, because then I can work out what to say. But whatever works for you, just make sure you know the difference and then be able to identify these two questions or answer these two. Which represents domestic demand? It is GDE. And which one represents the demand for domestic goods? That is expenditure on GDP. Incidentally, when we just talk about GDP, so as you'll see at the top here, when we are just talking about GDP, it is correctly termed expenditure on GDP, but often we don't say it in full. So when we just generally talk about GDP, we're actually talking about expenditure on GDP, all right? There, folks, is all your different abbreviations. And then a little bit of practice. So once again, I'm going to give you a moment or two to have a look at this, and then we'll go through each of them and see what calculation would be required in order to answer the questions that appear below the table. Alrighty, let's go see. First one, calculate the value of gross national product at market prices. All right, so we go check, what have they given us? Gross domestic product at market prices. So what is changing? There's only one thing that's changing. The D, domestic, is changing to national. Market prices, still the same, so no taxes, no subsidies having to get involved here. No gross to net, so no consumption of fixed capital. So all that we need here is that one. Because what we need to do is convert gross domestic product at market prices to gross national product. That is production by South Africans. So they've already done half the sum for us. So net primary income payments to the rest of the world. That means we've got to make a payment. That means this must be a subtraction. So 295 minus 29, and that is going to be your answer. All right, so focus for the moment, not so much on the numbers, focus rather on which of those items you're going to need in which of the calculations. All right, so that one would be there. So let's take that. It'd be applicable there. Then we go on to GDP at factor cost. Aha. So now we go back to what they've given us, GDP at market prices. So what is changing? Market prices is changing to factor cost. Now I'm looking for taxes and subsidies. All right. And I'm going from the customer back to the factory. So I go and I say, what must I do with my taxes? My taxes have been added on, so now I must take them off. So subtract my taxes, and I'm going to add back my subsidies. So I'm going to take my 295, I'm going to minus my 46 billion, I'm going to plus my 11 billion, and now I'm back to my factory cost. What was the cost of the factors of production? All right. So that was that one. And then we go to the last one, NDP at market prices. So market prices, still the same. We go back to our GDP at market prices. That's good. So we don't need to worry again about taxes and subsidies. So that's all good. We don't need to worry. That's the same as that. But what has changed? Now N has changed from G. So I've gone from gross domestic product to net domestic product. What do I need now? I need consumption of fixed capital. So there we go. Plus or minus, minus 39 billion. And there I've got my answer. All right, so that's why I've done it with you now first. Before I show you the answers are on the next slide for you. Next two slides, actually, so that you can see them. But really important for you first to go through. Don't try and learn these calculations off by heart. You can't do that. What you have to do is exactly what I've been doing now, is talk your way through them. You say, okay, what am I doing? What do I need to know? And then go step by step. You do that, you've got it. You don't do it, you don't got it, and you're going to fail the question if they ask it. All right. Simple as that. All right. There we go. Let's go have a look. There's your first one. First two, rather, done for you. And then your last one, done for you. And then I say here, remember that applying the rules is important. Show all steps in the calculation. You need to, one, apply the rules. When I say the rules, I mean the method. You've got to follow the specific method. And you've got to show me step by step what you do. Because if you don't, you're not going to get the marks. If you just give me a list of numbers, or your lecturer a list of numbers, chances are you're not going to get those marks, even if you got your answer right. All right. So please be very disciplined in your approach to these conversions. These are really conversions more than calculations. All right, that's the end of economic growth. Now, unfortunately, I don't have any of you here with me. I wish we did. And then I could have asked you, is there anything you want to go over? Is there anything you didn't understand? But at this point, I ask you to reflect on what we've done. If there was anything that's still confusing to you, that still you are feeling that you aren't quite mastering it, then make sure you ask someone, or go and investigate in your resources, notes, textbook, any slides that you have, all right? And then you should be absolutely fine. We don't know how many marks will be asked from that section. Remember, this chapter covers a lot of stuff. And they could spread questions throughout the whole chapter, or they could focus on one or two sections in the chapter. And we don't know what those are going to be. But for now, economic growth is done. GDP and all its related national aggregates. Now we look at the second macroeconomic objective, which is full employment. And how do we assess? How do we know if we are achieving full employment or not? We look at the unemployment rate. Look, we could also look at the employment rate, but generally speaking, we don't talk much about that. We talk about the unemployment rate, and you've got to be able to calculate the unemployment rate. Here at the bottom, you'll see there is your calculation, number of unemployed divided by the economically active population times by 100. What are we actually doing? We're taking the number of unemployed people in the economy as a percentage of the labor force. EAP is the same as labor force. Always pay attention to the information on the slide, which will give you that additional stuff if you need it. And we can talk to you about EAP, or we can talk to you about labor force. All right. Let's go and see what else I've got for you here. Remember, when we say someone is unemployed, we usually mean they want to work, but they can't find work. In general, that's what we basically mean. But when it comes to actually recording the information by Stats SA and anybody else who records our labor information, they have two categories, strict definition and expanded definition. The strict definition is what we basically talk about most of the time, and that is what allows us to compare our unemployment rate with other countries' unemployment rate, because they will all be using the strict definition. However, if we want to truly know how many people are willing to work, want to work, but have actually stopped looking for work because they've become discouraged, or maybe they've run out of money and they've had to go back from the urban areas to the rural areas, or perhaps they're just depressed and they haven't been able to go and look for work for the last month, then we are looking at the expanded definition. All right. So mostly we work with the strict, but you need to be aware that there is the strict definition and the expanded definition, and just be aware of the difference. We're not asking you at this point to learn the definitions. You will have to do that later for their final exam. But at this point, just know the difference between the two. All right, notice I haven't asked you to practice anything with calculating the unemployment rate, and that is not because it's not important. It's just because it's a very easy calculation, and I would assume you've all practiced it in class, and you should all be able to do it. Now we get on to the third macroeconomic objective, and that is price stability. And we now have to use the CPI to calculate the inflation rate. Can you describe what the CPI is? Would you be able to do that for 3 marks? There's your description. Would you be able to list the 5 steps for constructing the CPI? Please, students, you must be able to do that. It's a simple theoretical question that could be for 5 marks, and that's 10%. Don't want to lose that, all right? So looking at your 5 steps, make sure that you've identified them correctly. Just looking at 1 or 2 of them, you're going to have a selection of goods that go into the consumer basket. Then the goods are the contribution of each good, or the cost of each good relative to the basket, is given a weighting. And then the prices have to be collected of those goods. So that's just 3 of those 5 steps. Now, they are not things that you would know if you haven't learned them. Be sure that you do memorize them. Also, don't look at them and think, these are super easy, I'm going to remember them. Make sure you've remembered them, all right? Then who is responsible for constructing the CPI? You need to know that that is Stats SA. All right, used to be South African Reserve Bank. Reserve Bank publishes the information on the CPI, but it is Stats SA who constructs the CPI. And then there's another little tricky part in this particular section. Let's go have a look. Can you calculate the inflation rate using the CPI index? So if we give you the indices, here we've given it to you for 2021 and for 2022. In 2021, it was 138. In 2022, it was 141. And now we ask you to calculate the inflation rate. So once again, we're asking you to calculate here the rate of change. And notice how we do it. New minus old, divide by old, times by 100. All right, so just practice those a few times, making sure that you are able to do it. Super easy, super straightforward. You've just got to recognize that's what they're asking for. Here comes the tricky part in this section. Now, this question was put in a test on one occasion. In fact, more than one occasion, I think it's appeared. And students got terribly confused because they were all set up to do what we've just seen on this slide here, to calculate the inflation rate. But what they didn't notice is that this is the cost of a CPI basket, not the CPI index. So you can't just use those numbers, new minus old, divide by old, times by 100 to do your calculations. This is the actual cost of the basket. What you had to do was be able to create an index from that information, all right? And that, of course, brought us to these questions. So I'm just going to review with you quickly. Would you be able to do this? What is the consumer price index in 2017? Well, you've got a clue given to you in the question. It says here the base year is 2017. And what you should know is that the CPI index for the base year is always 100. All right, so that's a fairly easy one. That one you can learn. You can learn to calculate it as well, but for now you can just learn it. In the base year, your CPI, your consumer price index, will always be 100. But now we've got to go and calculate the index for 2019 and the index for 2020. And now you need to do what you presumably have learned in class, and that is that in order to get your index, you're always going to take the current value so that'll be whatever year you're working in. So current value over base value or base year value. So whatever the basket's cost was in the base year, and then times by 100. All right, so that's going to be base times by 100. Sorry, it's going to disappear off the screen there, but let's see if we can get it in. There we go, squash, we got it in. Current divided by base. So for example, if we want to go for 2019, so let's go 2019. That is going to be equal to your cost of your basket in 2019, current 243 divided by the cost of the basket in 2017, which is 190. And we're going to times that by 100. And you're going to get the answer. I'll show you. I'm not sure if I do show all the steps on the other side, but we'll see. I think I do. And then you do that calculation, and you should be getting, just double checking, it's 127.89. So that will be your index for 2019. And then you're going to do the same thing for 2020. Current over base times by 100, and you get your index for 2020. And now once you have your two indexes or your two indices, you now can calculate the annual inflation rate for 2020. All right, so this is the most difficult question you could be asked in this little section, in my opinion. For most students, they struggled. There you go. There's your index for 2019. There's your index for 2020. And now you can go and do new minus old, divide by old, times by 100, and you'll end up getting the inflation rate, which is 7.41%. All right. So ladies and gents, do the best you can with it. If it scares you a bit, then rather focus on the earlier stuff that I gave you. Make sure you can describe the CPI. Can you give the 5 steps for constructing the CPI? Who calculates the CPI? And can you calculate the inflation rate? All right. And then leave this one for just in case. All right, so that takes care of price stability. Remember, that's what we were looking at. And now we go and look at balance of payments stability. Folks, make sure you can describe what do we mean by balance of payment stability. And this is, we want an stable inflow versus outflow in the economy. So the money, the foreign exchange coming into the country and the foreign exchange going out of the country, we want it to be almost equal. That is what stability is. All right. So as soon as we've got a deficit, say on our current account, we need somewhere along the line to balance that deficit out, and maybe we'll balance it out on the financial account. But if we had a deficit on all of our accounts on our balance of payments, we would be in a certain amount of trouble. So just be aware that's what we're looking for in order to achieve balance of payment stability. How do we assess this? Well, we look at the balance on the current account. We look at the trade balance, we look at the balance on the financial account, and we also look at the impact of the exchange rate. Now, you've already learned about the exchange rate and the impact that it has on the current account when we did that little table in Learning Unit 4. Be sure that you still remember the impact that it can have, all right? We're going to go and do a little bit of testing because obviously you must be able to describe or define your balance of payments. Please make sure you can. And then you need to be able to identify the different accounts on the balance of payments. There we go, your definition. And there's your different accounts. Current account, capital transfer account, financial account, and your unrecorded transactions. Those are your 4 accounts, which if you look in your textbook, in the table that shows in chapter 13, you'll see there it lists the accounts that you must know. And then it also shows you all the items that appear under the current account, what appears under the financial account, and what appears or what should appear in the unrecorded transactions. All right. That information is in your textbook. I think the only one that they don't really spend much time on is the capital transfer account. And that one, I just say to students, just think immigration and immigration. So if people are moving into the country and they bring all their wealth with them, it'll go through the capital transfer account. And if people are leaving the country and taking their wealth with them, excuse me, it'll go through the capital transfer account. All right. But we're going to test you on these now. So let's go and have a look and let's see if you can identify correctly which accounts transactions would go through. Let's go have a look. Here we go. So now, hopefully you're playing along with me as you listen to this, and I'm going to give you a moment in each case to try and answer each of the questions. These are all international transactions. And what we want to identify is which main account and potentially which sub-account each one of them is going to go through. Let's start. A South African flower grower sells flowers to the United Kingdom. Think for a moment. All right. You should be able to tell me it is the current account and it would be merchandise exports. Although we think of as a flower as somewhat more delicate than merchandise, it is merchandise because it's not a service that we're sending. It is an actual product. So that would be current account, merchandise exports. Then we go to Transnet buys trains from Spain. Now, this one can cause confusion for students because you want to think of it as capital, which arguably it actually is. And then you want to automatically be able to put it through the financial account. But remember, the financial account is financial capital. It is not tangible goods. So our Transnet buys trains that would go through the current account through merchandise imports. All right, so Transnet buys trains, that would be your current account, merchandise imports. Amazon sets up offices in Johannesburg. Amazon being an international company, American, potentially, I think it is. Yep. Financial account, direct investment. All right, so financial direct investment. The argument is that they're not just putting money into the economy, they're actually coming here physically. They're going to be in business in South Africa. So Amazon sets up offices in Johannesburg, financial account, direct investment. You transfer money to a friend in China as a gift. Current account, current transfers. Out, so negative, all right, because the money is going to be leaving the country. So current transfers in the current account, negative. Then a South African doctor is working in a hospital in London. His or her income or contribution is South African, believe it or not. We will claim it as ours, and that would go through the current account, through income, receipts. And then an American investor buys shares on the JSE, financial, portfolio. All right, so I hope that's given you a little bit of an idea of the kinds of things that they could expect you to be able to deal with in the test. Maybe go and test yourself with some others by looking at the textbook and seeing what sort of transactions go through each of the different accounts. Have a look also at your other account in financial, just to double check what goes through that. And then also your unrecorded transactions. So make sure that you know your unrecorded transactions is your balancing item actually in your balance of payments. All right, so just go double check yourself. These are easy questions as long as you've at least looked at it once. So hoping you got all of those, folks. And then basic questions, which you can learn literally off by heart. So these are basic questions which you may be asked and easy to answer as long as you've kind of memorized it, right? And that is the end of balance of payment stability. And that brings us to the last one, which costs students big time. I think it was last year or the year before, because they asked them to describe all three of these methods used to measure the distribution of income, and students did not know them. Also, they misunderstood the question. They didn't read the question carefully enough, and they didn't even recognize what did we mean by equitable distribution of income. So I don't know what happened there, but it cost them big time. So let it not cost you this time. Make sure you can describe all three in detail, or at least as much detail as you see in front of you here. Each of them is important. Lorenz curve, Gini coefficient, quantile ratio. Remember that these two go together. The Lorenz curve and the Gini coefficient are linked because the Gini coefficient is obtained from the Lorenz curve. All right, so those two are linked, and quantile ratio stands on its own. So make sure you can describe, and quantile ratio is not easy to describe. This is the ratio between the percentage of income received by the highest percentage of the population and the lowest. So here we've used X and Y. Probably the easiest for you. So the richest X% of people and the poorest Y% of people. Don't go using the same letter in both places, because then you're going to be making an incorrect statement. So use different letters in each case, but make sure you can describe all three of these. And that, I do believe, takes us to the end. Oh, there we go. I've got one more little thing. Don't forget this graph. Super easy graph to draw. What is more difficult is remembering the labels. So remember, it's not just percentage of income, it's cumulative percentage of income. And here it is cumulative percentage of population. So just watch out that you do get those. And then remember, the line here is the line of perfect equality. And then this is your area of inequality. So depending upon how wide this is, we have greater level of inequality or less inequality. So for example, if I had to go and draw another line and put it in here, this would show a much more equal distribution of income. All right. But I think you got that, and that takes us to the end of Learning Unit 5. We go on now to Learning Unit 6, Chapter 17. Once again, folks, lots of application potentially here, but the possibility that they could test the theory. And that's what often scares me, because we spend a lot of time doing application with students, because that is where you mostly struggle if we don't, and you can't teach the application to yourself. We assume you can learn the theory, but then we often find that you focus so much on the application that you've forgotten about the theory. So as we go through this now, I'm going to try and remind you theory, theory, theory as well. All right, let's take a look. First example of questions. Identify any 3 assumptions of the simple Keynesian model and describe the implications of each. It goes without saying that assumptions have to be learned. You won't know them unless you learn them, because they are whatever we want them to be. It's not as though you have to have an understanding to learn the assumptions. You have to learn the assumptions in order to understand the model. All right, so NB, you've got to learn them. Go to the table in the textbook, make sure you've looked at them, and make sure you know that implications of each of them. We start off with very strict assumptions in Learning Unit 6, and then, as you've probably learned already, in Learning Unit 7, which is not for Test 2, we relax some of those assumptions, but we keep some of them in place. All right, so please learn your assumptions. Second question, briefly explain the difference between autonomous spending and aggregate spending in the simple Keynesian model. That's another place where students often battle. Make sure you can answer that. All right, just go and look in your textbook. You'll find the information there. It's an easy question that could be asked in Test 2. And then, of course, the one that we're going to also look at is, can you do the calculations that are required? And I tend to break the calculations down. Don't do it all in one. Calculate the multiplier, calculate autonomous spending, and then calculate the equilibrium level of income, because we don't know how they're going to ask it. They could just ask you a part of the question and not all of it. So be able to do it all in one, and then also be able to do it in bits and pieces. All right, now this is something that I've stressed with my students several times, and I'm hoping that now they finally get it. This is where we start. Whenever I start with the lecture on the Keynesian model, this is one of the first slides that students see. And the reason is because I'm introducing them to the relevant letters. And you've got to know, obviously, what those letters stand for. But now this becomes even more important, because what you need to be able to understand is that income, in the Keynesian model, income is always equal to production. So these two are always equal. They're the same thing. All right. And they are represented by the letter Y. But they are not always equal to A. All right, and that's the key. And now you've got to pay special attention to that. So it could be equal, but that will only be at equilibrium. It could be greater than, it could be less than. So please watch out for that, because that is a commonly asked question, and students mess it up every single time because they simply haven't grasped this little concept that I've just shown you here. Let's go and show it to you now in words. All right, in the national accounts, we say they're always equal. But that is in their national accounts. What that little slide previously was showing you was macroeconomic theory, not national accounts. So in the national accounts, yes, total production is equal to total income is equal to total spending. That is a given. It is done after the fact, and it is a simple accounting exercise. So they are made equal to each other. But when we are teaching economic theory, or we are analyzing the economy as a whole, we know that we can have 3 possible situations. Let's have a look. A is equal to Y. Aggregate spending is equal to the level of output. Please, if you're doing this in the test, you need to write this out in full, all right? I'm using abbreviations here because I want you to think about it. But if you were doing this in a test, make sure you write it out. Aggregate spending is equal to the level of income and output in the economy, or income and production in the economy. But we could have a situation where aggregate spending is greater than the level of output, and that would be called excess demand. And then we could have a situation where aggregate spending is less than the level of income and production in the economy, and that is excess supply. Now, ladies and gents, watch out for this question, all right? Because they like to ask this one, and students often don't know how to answer it. Seems kind of obvious to me when I look at it now, but it may not be as obvious to you. But hopefully you'll recognize it now if you see it. Then we go to those basic assumptions. And I've said to you already, learn and understand them. By understanding, we're saying know the implications. And then notice that they are very strict. They're very strict assumptions. And what they are is we end up with only two types of spending in the economy, because there's no government, there's no foreign sector. That means there's only households and firms. And that's what we mean. There are only two types of spending in the economy. What are they? Spending by households and spending by firms. Could be the question they ask you. All right. So they don't ask you to give them the assumptions. They just ask you what are the types of spending in the simple Keynesian model as a result of the strict assumptions. All right. So be careful that you can answer that. Your building blocks, what is it that you need to know for this model? C, I, A, at equilibrium, therefore. All right, so these are what we call the things that are essential. Without this, you have not got a clue what's going on. And then what we do is we go and investigate each of these. So we go and find out, all right, what makes up consumption spending? We're going to look at that in detail. Then we go and see what makes up investment spending. Then we put them together and we get our aggregate spending function. Then we're going to look at equilibrium. And then what we do is we solve for y at equilibrium. All right, so pretty much this sums up everything that we do, except for one thing that's not there, and that's the multiplier effect. And that comes in at the end, all right? Let's have a look. Here comes your consumption function. Oh, excuse me, I just was having a sneeze there. All right, your consumption function. At this stage, all we've got is C. All we're investigating is consumption spending by households in relation to YD. Now, we leave off the D at this stage because this becomes relevant in the next learning unit when we've got government. But for now, we don't need to have YD. We can just have Y there. Autonomous consumption is when Y is equal to naught. So if Y is 0, we still consume. That is autonomous consumption, and that is your intercept on your vertical axis. And then we show you that there's a positive relationship between Y and C, or between C and Y. What does that mean? That means when the one increases, the other one will also increase. Pretty kind of obvious, I would say, don't you think? And then what we have is to work out how much of each additional bit of income we earn do we spend. And what we look at there is what we call the marginal propensity to consume. So now we expect you to recognize that that is the gradient of the consumption function. And that's what we're looking at there. So this becomes the slope of the consumption curve or the consumption function. And that is our marginal propensity to consume. And what I always do to students is I say, let me put it actually in the pen. I say, when you're doing this, what you're doing is you're taking every 1 rand that we earn as a nation, and you're saying, how much do we consume and how much do we save? So what you're able to do is you're able to work out the marginal propensity to consume, and you're able to work out the marginal propensity to save. And there we go. All right. That's what you're actually doing here. So to try and make it a little bit easier for you to remember all of that, if you think for yourself, out of every R1 that you earn, how much do you spend or how much do you save? That is what we are looking at here. And then obviously you need to learn, what is it called? Marginal propensity to consume. And what is it? It is the gradient of the consumption curve. And there we have it again. In this case, we can work it out because you could go in and work out delta C. There's your delta C over delta Y. Remember, delta is change. So that would be 900 minus 100 over 1,000 minus 0. And that would give you your 0.8. What does this actually mean? This means that we consume or spend 80% of our income. Out of every R1, we spend 80 cents. Now we do it in words. So we did it graphically. Now we've got to go and put it into words. And that's everything we saw on the previous slide, but now we've given names to everything. We've got autonomous consumption, which is capital C with a line on top. We've got induced consumption, which is the relationship between the marginal propensity to consume and the level of income. And then we've got our marginal propensity to consume. And that gives us our consumption function equation, which is, of course, critical for this learning unit. Please, ladies and gents, you've got to know that one, all right? All right. So just going back quickly to this one, autonomous. Let's quickly just go back again. This one is your autonomous consumption, which we have learned is that consumption that happens even when there is no income. So where does that money come from? Well, mainly it'll come out of savings. All right, we have to borrow that money. So now there are factors that will affect this autonomous consumption, but it can't be income. We're going to go and have a look at what are those factors that will affect autonomous consumption. There they are. Interest rates, expectations, wealth, income distribution. Learn them. All right. And notice that they are non-income determinants or factors. Income does not affect autonomous consumption. It can't, because autonomous means it is independent of the level of income. And then the tricky little sneaky one, can you derive the savings function from your consumption function? Hopefully you've all learned to do this. Very simple if you've practiced it. Remember, you just throw a minus in front of your autonomous, and then you take that little number there and you say 1 minus whatever that number is. And that is what this equation shows you. So throw a minus in front of your autonomous consumption, plus, because it's a positive relationship, and then 1 minus your little marginal propensity to consume. All right. So let's have a look. 2 questions you could be asked. Let's have a look at the answers. You should be able to do that one already. Quick sticks. There you go. S is equal to negative 480. Remember, we've got to pay ourselves back first. So where did this money? This came out of savings. That's what I was telling you earlier. It came out of savings. That means we're in negative in savings. We have to pay that money back before we can start saving positively. And if we consume 60 cents out of every R1 that we earn, that means we can only save 40 cents or 0.4 out of every R1 that we earn. All right. And then if C is represented by, now we give you a new consumption function, and then we ask you to go and calculate the level of savings. And you'll notice with this calculation, our savings are still negative. We haven't yet paid back that 325 million in full. We're still busy paying it back at some point, though, at some level of income. So as this number gets bigger, we are likely then eventually to get to positive savings. All righty. Consumption and savings, done. Investment spending. Be able to define it, please, folks. Be able to recognize it's got 2 names. And then it does not respond to changes in income. Therefore, it is autonomous. Now, this could be problematic for many of you who are business-minded, because you may well feel that it's not an accurate statement. You are not entirely incorrect. We are making the assumption at this point that investment is autonomous. All right. We know that ultimately it does depend on the level of income, but for purposes of first-year economics, we treat it as though it is autonomous. So really important for you to make peace with any of that questioning that you might find in your mind when dealing with this. So if it is autonomous, then what is it that will affect the level of investment? Well, these should all make sense to you. Here they are. That factory that you want to buy, how much does it cost you? Or even that piece of machinery you want to buy, how much does it cost you? How much do you expect to make from it? Let's go back to the factory that you're going to buy. How much do you expect to make from it? And then the rate of interest. The rate of interest is super important from an economics perspective, all right? So there we have what are the factors that will impact on investment spending. 3 simple things which you should all know, even without studying it. Now we want to put this information into the graph. And we taught you first the C function. You saw it just now. We didn't do the graph now for the investment function, but I'm sure you've done it in class. And there we have our investment curve and we have our consumption curve. But at the end of the day, we don't want these 2 separate curves. We want everything in one. So we put it all together in our aggregate spending function. And that is now your A curve. And that is what we would expect to see in a graph. Look, if you had to do this, I don't think we'd penalize you. But it would make it unnecessarily complicated for you, all right? So what would we expect to see going forward? We would expect to see this. For aggregate spending function, there you go. Simple and straightforward as that. Look, this is not yet equilibrium. This is just looking at the aggregate spending function, but being able to put it into a graph like that with just your A is equal to C plus I, right? Now we're going to go and try and find out, what does this actually tell us? Does it tell us if we're in a good position? Are we at equilibrium? What other information can we get out of this graph that we're looking at? All right, we want to find out where is equilibrium, as we always do in economics. We're always heading for equilibrium in some or other way. And this time we're looking at national equilibrium. All right, let's go take a look. How the economy gets to equilibrium. Now, in order to be able to do that, we need a bit of extra information. So we're going to put into our graph what we call the 45-degree line. Now, you've probably learned that in class. The 45-degree line is called the equilibrium condition, and it identifies all those points where A is equal to Y. And then we will put in, together with the 45-degree line, we will also put in our aggregate spending line. All right, so let's have a look. There we go. There's our 45-degree line. There's our 45-degree line, shows all the points where aggregate spending is equal to income, all points of equilibrium. And there's my aggregate spending line. That shows me the actual expenditure in the economy. Now, there's only one point that we're in equilibrium, and that is where those 2 curves intersect. So equilibrium is always at the point of intersection between your A line and your 45-degree line, or your equilibrium line. All right, so remember that, because some students kind of felt like we were just choosing arbitrary equilibrium positions. Nope, only one point of equilibrium. And that's why in this case, I've labeled it YE. Now, normally we won't, we'll just label it Y, because it is assumed that we can only solve for Y at equilibrium. And mostly that's what we ask you to do, all right? But what if we're not at equilibrium? We could be in a situation here, or we could be in a situation here. Now we have to be able to identify and explain each of those situations and try and understand how we get to equilibrium. All right, so let's take a look. Here we go. A is greater than Y. So this is what this is showing you here. A is above my Y line. You can think of this line as being your production line. So what we're saying is that aggregate spending in the economy is greater than the level of production because we are only producing at Y1, whereas look at where my spending is. My spending is higher than Y1. What does that mean? Let's take a look. High aggregate spending, we're using up inventories. In other words, if you've got a shop, you're selling out your stocks big time. You keep ordering more, and so firms produce more, and as a result, Y will increase. That is driving economic growth. All right. So because people are wanting to buy more goods and services, we produce more goods and services, and so the economy grows. We may not stop at equilibrium, though, because we don't know where equilibrium is necessarily. So let's assume we go all the way to here, to Y2. What do we discover at Y2? A is less than Y, because there's A, that's the level of aggregate spending, and that is the level of aggregate output. So income or production is there, spending is there. What is the message that's being given to the economy? Now, remember, nobody specifically is giving this message. It's just what we discover through the operation of business. So when businesses are operating, this is what happens. So we see the following. A is less than Y. Yep, we get that. What does that mean? Low aggregate spending. Spending is less than production now. Unsold inventories build up. So those stocks in your store, you left at the end of each month, you left with stock. You're not going to order more because you've still got. So you don't want to order more when you need to sell what you've actually got in stock. Firms produce less, so you order less, firms produce less, and Y decreases. And with all this increase, decrease, what eventually happens is we end up at equilibrium. And of course, then you sell exactly what you ordered for the month. So for a month, you ordered a certain amount of stock, and that is exactly what you sell in that month. And now we know that whatever it is that we are producing on a monthly basis, we can stay producing that amount, all right? So that is how the economy gets to equilibrium. Look, they're unlikely to ask you that question in all that detail, but what they might do is ask you different parts. So they just ask you what happens in this kind of situation. And you've got to explain that. Or they'll ask you just what happens in this kind of situation, and you've got to explain that without a diagram. So they won't necessarily ask you the diagram. That's the theory that's more important. And now we get, of course, to the application part, which is calculating equilibrium level of income. And in order to do that, folks, you've got to know all of these. All right. I don't know how many of you have been practicing. I know some of my students have practiced a lot, and I'm hoping that they've got pretty good at it. You do get better. The more you practice, the better you get. There's no doubt. It's a bit like practicing a sport. The more you practice, the better you get. It's just exactly the same when it comes to these application questions. If you just do them over and over and over again, eventually you get clarity and you will know them, and they are super easy. All right. So please, hopefully you get there before the test. At equilibrium, we know aggregate spending is equal to income and production. What is aggregate spending? Remember, it is A without the line on top, and that is total consumption plus investment spending. Autonomous spending is only the autonomous portion. So autonomous consumption plus investment. Investment is always autonomous. So we don't have to keep reminding ourselves that it is autonomous because it is only autonomous. But remember, for C, we've got two parts. So that's why we've always got to tell you what is autonomous C, or we've got to give it to you in an equation like this one. so that you can recognize it. And then we expect you to be able to solve for y using these equations. Remember, these equations are both exactly the same. They're just different ways of expressing the same information. And then making sure that you can calculate your multiplier. There it is. Make sure you can do it. Let's go and have a bash. Here we go. Going to give you a little bit of time to have a look at that, see if you can get started with your calculations. Let's quickly go back. You can quickly make sure you've got the slide in front of you. And now let's go and see, can you do this? There we go. Going to give you a moment or two, and then I'll go through them with you. All right, so let's start off with the multiplier. The next slide does have all the answers nicely done for you, so don't panic. Is equal to, your multiplier for this learning unit is always 1 over 1 minus little c. Now your key is, where's your little c? There's your little c. By recognizing your consumption function, you should recognize that that is little c. Forget about the y. When you're doing the multiplier, you're not interested in the level of income. All you're interested in is the marginal propensity to consume. So that is going to be 1 over 1 minus 0.6, and that is going to give us 2.5. So that will be 1 over 0.6. Sorry, that point seems to have disappeared. There we go. And that is equal to 2.5. Casio calculator, pop it in the fraction function, and you should be able to see your answer quite easily. Then what is autonomous? What is the value of autonomous spending? Well, now you go and collect the information. What is autonomous? It is all the things with the lines on top, or all those factors or variables that are independent of income. In other words, they are not dependent on the income. And we know that A with a line on top is equal to C with a line on top plus I with a line on top. Now, even though this doesn't say autonomous investment spending in the little box here, we know that investment spending is always autonomous. So we know it's got to be that. And then the autonomous portion of consumption. So there's your autonomous portion. There we go. 566 plus 385, and there is your autonomous spending. Notice autonomous, not aggregate, right? And then, of course, you have to be able to go and calculate your equilibrium level of income, and that you use your y is equal to, and let's go and have a look at the information on the next slide. There we go. So there's your multiplier as we did. We did the calculation. There we can see 2.5. Your autonomous spending, there it is. And then your equilibrium level of income. Now, you can do it like this, all in one, but you've already done all the work. So you could take multiplier times autonomous spending is equal to, and those two will give you the same answer. All right, so whichever one works for you, it doesn't matter. If you are asked to calculate equilibrium, you can use either one. They are the multiplier method or the Keynesian multiplier method. I prefer to remember to name it after the person who it is named. We are studying the Keynesian model, although at the end of the day, he wasn't responsible for the calculations per se, I don't think. I think that is followed afterwards, but it is still Keynes's model that we are studying. Folks, I hope you've got that. You've got enough examples, I'm sure, to practice with. Make sure you go through as many as you need. You can go through the same one over and over until, as I say, you click. And once or the light bulb comes on and you get your light bulb moment, and then hopefully it stays on at least until the test. All right, now what we're going to do is we're going to take all of this information that we've calculated and we're going to go and put it into our graph. So there's my autonomous, so that's going to be my intercept for my A line, and there's my equilibrium level of income, which I'll put into my graph as well. So here we go. There's our 45-degree line. There's our autonomous. There's our A line. There's our equilibrium. And that is as simple as that. And then the last step in this whole process is you have to be able to explain and potentially illustrate the multiplier effect. And the multiplier effect you have already seen, because in fact, the previous calculation, which we've just done, was the multiplier times autonomous spending. So we know that this here, this number here, is this number here multiplied by whatever your multiplier was, which in this case, it was 2.5. Now, many of you may not have got to that point yet, so don't stress about it if you haven't, but then try and follow through what we're going to do now. So we're going to say what happens when this increases. So aggregate spending or autonomous spending increases. What happens to the level of income? Well, we should now know, intuition should tell us, that if we spend more in our economy, we'll produce more. Therefore, aggregate income production will increase. But we want to know by how much, because we want to know if we come and put money into this economy, what sort of result can we expect as a consequence? Let's take a look. All right, so back in the starting position, equilibrium. Now we're going to go and increase our investment spending of 100 million. So we're going to increase this by 100 million. There we go. So 951 plus 100 gives us a new aggregate spending line. There we go, A1, and therefore a new level of output. Could you quickly calculate that? Let's see if you can quickly do it. So quickly see if you can calculate. Remember, all your other information remains the same. In other words, your marginal propensity to consume, which is the gradient of this consumption of this aggregate spending function, is still equal to little c. Let's use an actual pencil. Little c is equal to 0.6. So you can still calculate your multiplier. Your multiplier is still the same. 0.6 is your marginal propensity to consume, or your gradient of your aggregate spending function, and therefore your multiplier is equal to 2.5. All right, so that is still the same information. That should allow you very quickly to work out your new level of income. All right, we're going to go on to the next slide and see who's got it right. There we go. That should have been your answer, folks. You should have been able to get to that. All right, and what is super important is this little thing here. Because what does the multiplier effect tell us? It tells us that the change in income, in other words, delta Y, will be greater than the change in investment. And you can do a quick calculation. If you take the difference between these two and compare it to 100 mil, you will find that the difference here is greater than 100 mol. Easy peasy. All right. And that pretty much is that. So all of that information is what you need in your head going into the test for the Keynesian model. And not just to do the calculations, folks, but to be able to tell us what are all these things. Because that may be what they ask you. All right, so learn it with a bit of understanding. It'll help you immensely. And then all remains is for me to say good luck. Sorry you weren't here to be with me. I would have liked your questions and your insights and your contributions, because they often remind me of things that I need to tell you that maybe I forget when I'm on my own. But hopefully this is beneficial. Good luck. Let's go nail that test, folks. Cheers, hey.